This video expresses how a person should approach their priority as far as building their financial foundation. Okay, building your financial foundation is like building a house. You must build it from the ground up. Build it right, build it strong. Okay, if you look to the right of the screen, you'll see the pillars, the four pillars of finance, and how to build a successful foundation. Protection, which we just described in the previous video. Okay, next is debt management. You want to be able to manage your debt correctly. For any type of credit card or loan that you have, you want to make sure that you pay more than the minimum to reduce your debt sooner. Okay, the example that you'll see right here on the bottom left is a $4,500 credit card balance that charges an interest rate of 18%. Okay, scenario one. The minimum payment with this balance would be $112.50. Okay, if you continue to pay that over the years, it would take you over 25 years to pay it off. And you would have also given the bank $6,000 in interest, which is pretty much free money for them. Scenario two, if you pay a little bit more than the minimum, and we'll just say $145, it'll take you less than 4 years to pay it off, and you only give the bank $1,600 in free money in interest. So you want to make sure that you control your debt, or it will control you. Okay. The third pillar, emergency fund. You should set aside 3 to 6 months of income to help cope with emergencies and unexpected changes. In these emergencies and unexpected changes could include job loss, major damages or repairs for homes, business properties, cars, etc., illnesses, disaster, and being prepared for rainy days. The last pyramid is investment. That could be anywhere from investing in your brokerage accounts or investing in a house or whatever it is that it may be. But if you think about it, if you start from the top and read down, okay, that's pretty much how people start off. People start off, they'll graduate from college, and they'll invest in a home, invest in a car, invest in furniture, and buy a lot of doodads or depreciating investments. Okay, and then they don't have any emergency funds. So what they do is, since they don't have any emergency funds, they go further into debt and get credit cards to help pay for the debts that they've already accrued. So the general person will apply for credit cards to help pay off school loans, car loans, furniture, etc., and still not have any money saved over. And then people not think about protection because, especially if they just graduated, they're young and they feel that they don't need it right now, and so that they just forego the protection. So we want to make sure that we don't think opposite, investing before we know how to manage our debt and have emergency fund. We want to make sure that our foundation is sound with the protection, with the life insurance, have sound principles on how to manage our debt, create an emergency fund so that we'll have money set aside for special occasions or emergencies. And then lastly, once those three pillars are covered, then lastly, invest.